Good evening. This is Ken Long from Tortoise Capital with a review of the weekly and daily trading plans for October 15th, 2011. We have a market that's still in bearish normal conditions. It's at 60 out of 100 on an annual basis using weekly RSI 14. On a 10-day basis, it's at the top of its 10-day trading range, so overbought on a 10-day basis on a score of 100 out of 100. Looking at the market mosaic, the percent stretch relative to the 200-day moving average is still bearish because we're minus 3.21% below the moving average, but that's coded yellow, meaning that it's been improving over the last 2 weeks, and we are within 1.5% of going into sideways conditions. The 5-day slope of the 50-day moving average is coded white, so above average compared to the last 180 days. It's still negative at minus 2.0, but it has strengthened considerably, and it is now considered bullish because it's above average slope. The ADX reading at 15.7 is neutral, and that's pure sideways, and that's because last week this time it had been strongly bearish, and the positive price action of the last week has now erased the bearish tendencies and put us in pure sideways on a technical basis. So at 15, that's the boundary of any trendiness, and this is a good place for the next trend to emerge, whether that be up or down. So trend following players ought to be prepared for the possibility of a 2 to 4 week trend beginning out of the area we're in now, and that can go long or short, but the possibility for an extended trend is now in place. ATR percentage at 2.49% is at the is rated normal. It's above average, but right in the middle of average. The blended monthly rebalancing current holdings remain the same. Our next scheduled time to rebalance is 1 November. ETF2, the theoretical exposure is that's incorrect on that report. It should be 20%. The model portfolio will be at 20% exposed on Monday with buys in utilities and treasuries for Monday morning. Taking a quick look now at the ratings for the 13 and 26 ETF portfolio, you see we're still dominated by the defensive plays in both. We have treasuries and gold at the top of the list. Meanwhile, among the equity indexes, NASDAQ, Dow Jones 30 Industrials, the U.S. large caps are at the top. All of the risk-on trades are at the bottom, featuring U.S. small caps, Latin America, and emerging markets. On the 26 ETF portfolio, you'll notice the financials in Brazil are coded red, so under extremely oversold conditions. Moving on to the market health check. Again, we look at this chart starting from the top. The vertical blue lines represent 10, 20, and 30-day look-back periods. The solid purple line at 137 is the swing high for this channel, this sideways channel we've been in, going back to end of March of this year. So the top end of the channel is at 137. The solid red line at the bottom is the swing low at 107 from 2 weeks ago. So we have a 30-point channel between 107 and 137 that we've been operating in. The solid black line in the middle of the channel here is the 30-day regression line. The slope is downward, indicating negative recent trend. You'll notice price is at recent resistance at 122. If you look to the west, you'll notice that there's been 1, 2, 3, and off the chart 2 more tests of 122 that have failed in the last 6 months. So 5 times it's knocked on the door. This one looks stronger than previous ones, but still 122 is a significant resistance area it has to get through. 125 is the next resistance area. If it gets up to 125, we'll be in sideways market condition, then past the 200-day moving average at about 127. Resistance at 130. We will still be technically in a channeling market until we get a close above the swing high at 137. We've moved 15% off this swing low here at the bottom of the regression channel from 107. So that's a considerably stronger move than we've seen in the past, recent past in this channel. The outer two black lines are the channel formed by the maximum excursion from the regression line during the look-back period, which occurred in the first week of October, and we're near the top of that regression channel. According to that indicator, if we get a close above 125, that will be an indication that we have a change of market state, and that would coincide with our move into sideways conditions. So the first couple of days of this next week will be crucial to determine if what we have here is just simply the top end of a bearish channel or a potential breakout to the beginnings of the next bull move. So we got to be prepared for sharp reversals and then sharp expansion from this doji. So that's good for tactical traders that can adopt a flexible attitude on direction. Looking at Williams percent R10, we're at in overbought conditions and have been there for 3 or 4 days, in fact all of last week, and so that can be favorable. Again, we can always be overbought for long periods of time, but this is a natural place for it to reverse should the resistance at 122 hold. If it holds, or if the resistance holds and it fails from here, the next swing target on the downside would be at 115, which is back to the median of that regression channel, and that's a 7-point move on 122, which is about 5%. Next indicator we'll look at is the percent price oscillator in the middle. That's a first cousin of the MACD histogram. It gave a bullish signal, on the 10th of October, and the jaws are still open and pointing upwards, and so there's room for it to grow and go. That technical indicator has an upward bias right now. The final indicator on the bottom is the slope of the regression line. It is back to just a shade below the zero line, meaning that we're close to a sideways market here. So a weakening bear, the beginnings of a potential bull. It has to break through and close above 125 and hold. That'll get us into sideways, and then perhaps the beginning of a test of 137 would be our next target. You can see the ADX line at the very top is dipped below 15, and the bulls are now slightly in charge, so there is a beginning of a bull emerging out of this sideways channel that we've been in. So tactical traders market, be ready to reverse. Don't have a directional bias yet, but it's very likely that we can see a 5% move out of this location during the next week. Swing traders are favored right now because if the bull continues, you're going to see some nice bull trends beginning to develop. Moving on. Looking at the ETF2 regional report, 8 of the 10 regions are on a cash signal. 2 of them are on a buy, and that moves us up to 20% invested, 80% cash. The SPY is better than the EFA. SPY at 39, EFA is at 32. So the U.S. is still stronger than the globals right now. Inside the U.S., the strength remains as it has been for the last month. Technology is better than the large caps, better than the mid caps, better than the small caps. The 2 strongest sectors in the data among these 10 in the database are the NASDAQ 100 and the U.S. large caps. The 2 weakest are emerging markets in Latin America, still exhibiting flight to quality in the U.S. Taking a look at the world market model now, these numbers are coming from the strength report on ETF2. Taking a look at the inside the U.S. sector to begin with in the center zone here, you can see the strength in the NASDAQ at 48 is in the green, and then all the large caps are above average, and then the mid caps and the small caps are slightly below average. Still strength in the defensive plays, gold, silver, and treasuries, although they're weaker than they have been before. U.S. real estate in the red may have an extreme bottom being put in. Asia, slightly better than Europe right now, but the clear leader is Australia, followed by Hong Kong, Malaysia, Singapore. Weakness in Asia, in China, South Korea, and India. Latin America, emerging markets, generally below average, extreme weakness in Brazil. In Europe, the leaders are Spain and the UK, weakness in Germany and Austria. Among the U.S. and global business sectors, the defensive sectors still are dominating with healthcare, utilities, and staples, and global technology is a strength as well. So that's the area I would expect to see continue to dominate if this turns into a bull market from this position. Inside the currencies, the yen and the dollar up are strong. Moving on. Taking a look at the 100 by 200 system, we've had a number of the short positions go back to cash. The clear leaders on this longer term look back remain utilities, treasuries, and gold, and still short positions on a technical basis in the U.S. indexes and most of the globals. The defensive sectors are the ones that have led the way back into cash, and I would expect them to continue to be the leaders going forward if the bullish tendency continues. Taking a look at the top 30 liquid ETFs from the ETF2, it's dominated by the defensive plays as it has been for the last 3 months. Treasuries, gold, precious metals, interest ETFs. The first equities that we see are utilities, and then consumer staples, the Select Spider XLP, and that's going to have all your Disney's, McDonald's, Coca-Cola, Johnson & Johnson, Pfizer, and so forth. So that's sort of a natural play for money that's looking to get long in equities right now is going to the defensive sectors and the large caps in the U.S., and if the bull continues, XLP is a good proxy to own to take advantage of that longer-term move. Looking at the ETF liquidity report, these are the top 30 ETFs based on their average daily dollar volume, ranked by daily dollar volume. And you can see right now the short-term VIX VXX is trading at 8% daily ATR, 8.22%. So that's a very interesting target for short-term moves. It's getting killed right now based on the return of the young bull, and I would expect to see that to continue to be a useful trading vehicle next week. If the bear resumes, the VIX is in a position to have an extraordinary move. Right now, based on its 10-day high, it has a reward-to-risk ratio in excess of 9, so that should be on your short-term trading list. All other members of the top 30 look to be about the same. Silver's holding steady at about position 13, gold in strong position at 4. That's the weekly trading plan review, and we'll do the daily trading plan shortly. Thanks for your attention. Good trading.